Over the next 10 years, an unprecedented $37 trillion will move from baby boomers to younger generations. This chart maps a $5 million inheritance over time. For the average heir, that balance drops to zero within exactly 7 years. Building wealth requires capital allocation and discipline. Inheriting it usually only requires consumption. Because these two actions rely on different skill sets, the capital rarely survives the transition. This consistent loss of capital happens because the transfer lacks a protective layer, a network of specialized services and systems designed to catch it. If you build that layer, you can capture the value of the flow. Without a deliberate architectural override, inherited money simply fuels lifestyle inflation until the bank account returns to zero. This creates a market for the professionals who can design those systems. The first play is estate architecture consulting. Families pay $50,000 to $300,000 to professionals who build inheritance frameworks. These include trusts that release capital in portions based on specific life milestones, ensuring the money survives across generations. This diagram illustrates charitable giving arbitrage. Investors choose between the red path, where capital gains taxes reduce the assets, and the green path, where donating assets secures an immediate tax deduction. The vehicle for this choice is a donor-advised fund. Families deposit capital, take the deduction today, and pay out to charities over time. Capital sitting in these funds went from $40 billion to over $175 billion in 10 years. Play 3 involves family office infrastructure. Once a family's net worth exceeds $30 million, traditional wealth management loses its effectiveness. At this level, a family must consolidate investments, tax strategy, and real estate operations under one roof. Managing the accounting and technology for these family offices becomes a comprehensive service model. Play 4 focuses on skills transfer. When heirs with financial safety nets take over, they often lack the operational discipline required to keep family businesses or real estate portfolios from deteriorating. That brings us to Play 5, Liquidity Event Advisory. Families with $50 million real estate holdings face a binary choice: hold the asset forever or execute a strategic sale to diversify. Without expert advisors guiding the deal mechanics and tax efficiency, families leave millions on the table through poor negotiation. Play 6 is alternative asset positioning. Heirs often default to passive index funds, missing the higher yields available in private equity or private credit because they lack the sophistication to manage those risks. Play 7 addresses the behavioral risk. A 25-year-old handed $20 million has no preparation for that responsibility, frequently leading to self-sabotaging financial decisions. By identifying these specific points of failure, from operational neglect to psychological burnout, you can build services that prevent the inevitable drain of assets. Play 8 is governance infrastructure. Large families require investment committees and family councils to resolve conflicts. These structures require professional facilitation to function. Play 9 is the technology infrastructure play. Many wealthy families operate with massive inefficiency because their records are fragmented across different banks and legal jurisdictions. This visualization shows the solution. Consolidating these scattered records into a unified dashboard allows a family to see their total exposure and make informed decisions. Play 10 is education infrastructure. Families pay for systematic programs that build financial competence in the next generation before they receive the capital. Play 11 involves insurance and risk transfer. Advisors identify and hedge specific threats, like a business's dependency on a single key person or potential litigation exposure. As family portfolios scale, the primary threats transition from individual behavior to systemic fragmentation. Technology and governance advisors become integral to the survival of the estate. Play 12 is real estate optimization. Property portfolios often underperform when they are held for emotional reasons or when maintenance is deferred. Play 13 is the tax optimization infrastructure. Strategies like cost segregation and opportunity zone positioning can shield millions from unnecessary taxation. Play 14 is international structuring. Families with global assets require experts who understand cross-border transaction mechanics and foreign reporting requirements. Play 15 is succession planning. The wealthiest families prioritize the transfer of both their capital and their values across multiple generations. Mastering these final optimization levers makes a partner a permanent fixture in a family's financial history, securing the highest professional fees. The wealth transfer moves through a complex web of legal, technical, and operational gates. By operating those gates, you capture service fees on the trillions moving between hands. To learn how to position yourself inside that ecosystem, subscribe to the Money Formula. Drop a comment below with your focus area, whether that is trust structuring, family office tech, or advisory. Position yourself now before the capital migration accelerates. Future revenue depends on the infrastructure you build today.